Something shifted this week, and the people who trade silver for a living felt it before you ever saw a headline. Not because of what was announced, because of what the announcement told them about what comes next. And if you own silver or gold, or you have been sitting on the sidelines wondering whether you already missed it, I need you to understand the thing the trading desks understand and are counting on you not to. The market does not move on the event. It moves on the expected path to the next one. I want to be honest with you about the stakes, because the financial channels never are. If you are a retiree with real money in a retirement account, the difference between understanding this and not understanding it is the difference between reacting to noise and reading the signal. It is the difference between getting shaken out at exactly the wrong moment and sitting still with your hand on the wheel. By the end of this, you will understand why silver just changed everything and why the change happened in a place most people never think to look. So let me give you something concrete right now before I earn one more minute of your patience. Here is the mechanism nobody explains. When the central bank makes a decision, the metal often barely flinches on the news itself. The real move already happened in the days and weeks before, as the market priced in what it believed was coming. And the truly violent moves in the history of these metals did not come from a decision at all. They came from a hint, a whisper about the direction of policy down the road. That is the whole game, and once you see it, you cannot unsee it. Let me take you back to a moment that proves this, because it is the cleanest example in modern history, and it is the spine of everything I am going to tell you today. Go back to 2013. The Federal Reserve had been buying bonds on a massive scale, pumping liquidity into the system, and gold and silver had ridden that tide higher for years. Then, one day, the chairman of the Fed did something almost gentle. In testimony, he merely suggested, that at some point in the coming meetings the Fed might begin to slow the pace of its buying. He did not stop buying. He did not raise a single rate. He simply hinted that the extraordinary support might someday, gradually, ease. The market did not wait for the event. It reacted to the expected path. What followed is now remembered as the taper tantrum, and it was violent. Bond yields spiked, and gold, which had spent years climbing, fell hard, sliding roughly 28% across that year. Silver, as it always does, moved with even more force, because silver is the smaller, thinner, more emotional market. And here is the part one need you to sit with. Nothing had actually happened yet. No policy had changed. The Fed was still buying. All that changed was the market's belief about the road ahead. The anticipation beat the event. The whisper beat the announcement. Now hold that thought against this week, because this is where the title comes home. The Fed just made its latest decision, and on its face, very little happened. Rates held steady, as they have for several meetings in a row now. If you only read the headline, you would think nothing changed at all. But that is exactly the trap. The metal was never trading the decision. It was trading what the decision reveals about the expected path from here. And under a new chair, Kevin Warsh, the ground under that expected path is moving in a way that the desks noticed immediately and the public has not. Let me explain what I mean, because this is the reveal, and it is not what you were told. The old way the Fed operated was to hold your hand. It would give the market forward guidance, a gentle set of promises about what it intended to do next, so that everyone could see the path and nobody would be surprised. That guidance was a comfort blanket. It let the desks price the future with confidence. And under the new leadership, that comfort blanket is being pulled away. The forward guidance is being stripped back. The chair has been blunt that inflation is a choice, not an accident, and that he is not in the business of soothing the market with promises about tomorrow. You see what that does? If the market trades the expected path and not the event, then the single most important thing in the entire system is how clearly it can see that path. And when the hand-holding stops, when the guidance disappears, the path goes dark. The uncertainty about where policy is heading goes up. And uncertainty about the future value of paper money is the exact condition under which real, physical, unprintable money quietly gets more valuable. That is not a headline. That is plumbing. And the plumbing is where the truth lives. I want to pause here because we have reached the first place where I owe you something practical, not just an explanation. If everything I have said so far is landing, you are probably feeling the thing every honest retiree feels at this point, which is a quiet unease about how much of your future is denominated in a currency whose caretakers just stopped telling you where they are going. So here is something worth knowing. The largest, most sophisticated buyers on the planet, the central banks themselves, have been accumulating gold at a record pace, well above what they bought in the decade before, and they accelerated after they watched one nation's foreign reserves get frozen overnight and realized that gold sitting in your own vault is the one reserve no other country can switch off. They are quietly doing for their own balance sheets exactly what a prudent household might consider. And here is the part almost nobody tells you. There is a perfectly legal, perfectly ordinary way for you to do the same thing inside the retirement account you already have. You can move a portion of an existing retirement account into physical gold and silver, real metal, held for your benefit, without triggering taxes and without triggering penalties, using a structure called a self-directed precious metals retirement account. I put together a free guide that walks through exactly how it works, in plain language. And this is not some insider club. If you have $100,000 or more in any retirement account, this is for you. If you are watching on your television, just scan the QR code on your screen. If you are on your phone or your computer, go to jeffreedguide.com. Take a look, then come right back, because the next part is the part that actually changes things. Here is the re-hook, the thing almost nobody gets to. Why silver specifically, and not just gold? Because silver is where the market's shifting expectations get amplified the most. Gold is the calm giant. Silver is the same story told louder. When the expected path to the future gets murkier, gold responds. But silver responds with force. Because it is a smaller market, it is half industrial metal and half monetary metal. And it carries a coiled spring inside it that gold does not have. And that spring is a supply problem the desks would rather you never think about. Let me give you the concrete details, because this is where deep research beats headline noise. The world has run a structural silver deficit for several years running, meaning we use more of it than we produce and dig out of the ground, and the gap gets covered by drawing down stockpiles that are not infinite. And the demand side is unforgiving in a way gold's is not. Gold is hoarded. It gets bought and it gets stored, and almost every ounce ever mined still exists somewhere. Silver is burned. It goes into solar panels and electronics and medical devices in tiny amounts, a few grams here, a fraction of a gram there, dispersed so thinly across so many devices that it is largely uneconomic to ever recover. It gets used up, and it does not come back. Gold is saved. Silver is consumed. And a monetary metal that is also being physically consumed is a very unusual thing to be sitting cheap. And there is a tell in the numbers that proves silver is the amplifier. Look at what happened in 2020. In the span of a few months, silver crashed toward the low teens in the spring panic, and then ran toward 30 by late summer. The ratio between gold and silver, the number of ounces of silver it takes to buy 1 ounce of gold, spiked to an extreme, one of the widest readings on record, and then compressed hard as silver came roaring back and outran gold. That is the coiled spring in action. Gold tells you the direction. Silver tells you how badly the direction was underestimated. When the two get far apart, it is not because silver became worthless. It is because fear ran to the calm giant first and left the smaller metal coiled and cheap, waiting. Now layer the expected path idea on top of that supply story, and you understand why this week matters. Silver is not just reacting to a decision. It is a small, tight, deficit-ridden market being asked to price a future that just got harder to see. When the guidance disappears and the path goes dark, the safe haven bid and the monetary bid both flow toward metal, and they flow toward the smaller market with disproportionate force. That is not a prediction. That is the structure of the thing. It is why silver so often sits still, and then moves in a way that leaves people staring at the screen, wondering where it came from. And I want to be fair, because the same mechanism that lifts silver can also punish it, and you deserve the honest version. The desks have tools to shake you loose. Think about what happened in 2011. Silver had run all the way up toward that famous $50 ceiling, and then the exchange raised the margin requirements, the amount of money you have to put up to hold a futures position, several times in quick succession. Silver fell around 30% in a matter of days. And here is the thing you must understand. Not 1 ounce of silver became less scarce during those days. The supply deficit did not change. The industrial demand did not change. What changed was the cost of holding the paper contract. The exchange moved the cost of holding the metal, not the value of the metal. And a frightened holder, watching that drop, sold real ounces into the panic and handed them to someone patient and calm at a discount. That is the enemy in this whole story, and I want to name it plainly, because the financial channels never will. The people who profit when you are afraid are not on your side. The trading desks make their money on your churn, on you buying high in excitement and selling low in fear. The financial media sells your attention by keeping you reactive, jumping at every announcement, treating the event as the story when the expected path was the story all along. They would rather you watch the decision and miss the mechanism. They would rather you never learn that the whisper beats the announcement, because a holder who understands that is a holder they cannot shake out. Your calm is their lost commission. Let me connect this back to real people, because a mechanism is abstract until it happens to a saver at a kitchen table. Picture someone who did everything right, worked for decades, saved diligently, built a real nest egg, and holds a sensible position in metal because some quiet instinct told him that paper alone was not safety. Now picture the shakeout, the margin hike, the sudden drop, the red on every screen, the anchor on television calling at the end of the run. That saver, if he does not understand what you now understand, sells into the bottom, exactly what the desks were engineered to make him do. But the saver who knows the metal did not change, only the cost of holding the paper did, sits still. He sized his position so that no single drop could force his hand, and he is still holding when the anticipation, once again, beats the event. Because here is the long view that ties it all together. This is not the first time the market has traded the Fed's expected path instead of the event. It is the only thing the market has ever really done. There was a stretch, decades ago, when the central bank was pinned to hold government borrowing costs down, and everyone knew it, and metal behaved accordingly. There was a time when a chairman flinched at an oil shock and let inflation run, and the metals priced the flinch long before the inflation fully arrived. And there was the man who took rates to the high teens and broke the metals for a generation, because a bond that pays a real return above inflation is the metal's only true enemy. In every one of those episodes, the metal was not trading the meeting. It was trading the credibility of the path. And if you want proof that the expected path now matters more than the old rules ever did, look at how the relationship has broken. For a generation, the textbook said gold falls when real yields rise, when bonds start paying a return above inflation, because a bar of metal pays you nothing. That was the iron law. Volcker used it to break the metals. And yet, in recent years, gold has climbed even as real yields stayed high, snapping the very correlation that defined it for decades. Why? Because the buyers who set the tone now are not chasing yield at all. They are central banks and long-term holders pricing something the old model never measured: the risk that the caretakers of paper money cannot be trusted to hold the line, and the value of an asset no other nation can freeze. Gold recently overtook the euro to become the second largest reserve asset held by central banks in the world, behind only the dollar itself. That is not a trading blip. That is the deep tide turning, and it turned while the crowd was watching the headline. And that brings us to now, and to the recognition I most want you to carry out of this video. The smart money already sees what I have described. The central banks are already buying at a pace we have not seen in generations. The desks already understand that stripped-away guidance means a darker path and a stronger monetary bid. They are already positioned. What has not happened yet is the moment the mainstream catches on. Right now, the financial press is still reporting the event, the decision, the hold, and missing the mechanism entirely. The pension funds and the everyday advisor are still treating metal as a sideshow. We are not yet in the moment when this leads every broadcast, and every advisor suddenly recommends it. And that gap between what the smart money already knows and what the crowd has not yet realized is the entire opportunity. By the time it is obvious to everyone, the easy part will already be behind us. Nobody is going to call you and tell you to act. Nobody sends you an invitation to be early. So let me be as honest with you as I would be with my own family, because you have earned it. I cannot promise you a price, and I would not trust anyone who does. The volatility is real, and it cuts both ways. The desks will try to shake you loose again, and they may succeed for a while. This is a case built on structure and history and mechanism. It is not a guarantee, and it is not personal financial advice. So here is the practical part. Own the metal, the real thing, not a paper promise you cannot hold. Size your position so that a shakeout, and there will be shakeouts, can never force you to sell. And whatever you do not sell into the fear the desks manufacture. The saver at the kitchen table who understands the expected path is the one who is still standing when the path reveals itself. Which brings us all the way back to where we started, and to the question in the title. Did silver just change everything? Not because of what was announced this week. Nothing dramatic was announced. Silver changed everything because of what the announcement quietly told the market, and because that path just got harder to see under a new chair who has stopped promising where he is going. The event was small. The signal underneath it was not. And you, unlike the crowd, now know the difference. That is what changed. You did. If you watched all the way to here, this last part is for you, because it means you are exactly the kind of person who reads the signal instead of the noise. For viewers with $100,000 or more in a retirement account, I hold a free, one-on-one, no-obligation educational web conference, and all you have to do is mention that you watched this video all the way through. I will be honest about why now, and it is not fake urgency. It is the opposite. The moment to think clearly about protecting what you build is precisely the moment when nothing feels urgent, when the headline says a quiet hold and the crowd has moved on. Because that calm window is exactly when a decision like this is still cheap and still fully reversible. Once it is obvious to everyone, that window is gone. If you are watching on your television, scan the QR code on your screen right now. If you are on your phone or your computer, go to jeffreedguide.com. Bring your questions, bring your skepticism, and let us walk through your situation together, calmly, while it is still early.